They never announce it. They never publish it in op-eds. They never discuss it at the conferences where they smile for cameras and talk about global cooperation and shared prosperity. But 18 to 24 months before every major economic crash in modern history, a very specific behavioral pattern appears in the SEC filings, the private auction records, the farmland transaction data, and the quiet acquisition reports of the ultra-wealthy. The same pattern. Every time. Without exception. The mainstream financial narrative has told you for decades that crashes are unpredictable, that diversification is your only shield, that timing the market is a fool's game. That story is true for one group of people. It was never designed to protect the other. The other group, the one whose quarterly filings and private wealth reports paint an entirely different picture, has been running the same playbook for over a century. And by the time the crash arrives and the financial media starts explaining what happened, that group has already positioned itself to buy everything the panicked majority is desperately selling. Here are the 5 assets they accumulate before the crash arrives. One of them is technically available to anyone with a brokerage account. Most people have never considered it. And the 5th one is the mechanism through which entirely new fortunes are constructed during downturns, not merely preserved. This is not theory. This is the forensic record. The first asset is the one that sounds the most boring. And in the language of institutional wealth, boring means lethal. Before the dot-com collapse in 2000, before the 2008 financial crisis, before the 2020 COVID shock, one pattern appeared consistently in the SEC 13F filings of the wealthiest institutional investors in America. They were not buying gold. They were not rotating into commodities. They were buying short-duration government paper, treasury bills, 90-day sovereign instruments yielding barely more than a savings account. Warren Buffett's Berkshire Hathaway reached over $130 billion in T-bills and cash equivalents by mid-2023, before the regional banking crisis, before the commercial real estate reckoning began. The financial press called it missed opportunity. They said he was too conservative. They said the old man had lost his edge. What he was doing was loading the gun. This is the first truth that separates ultra-high net worth behavior from conventional financial wisdom. The wealthy don't treat cash as something that costs them yield. They treat it as the only asset that converts into every other asset at the exact moment when those assets are bleeding out. The mechanics are simple and devastating. During the 2008 to 2009 crash, S&P 500 companies lost roughly 57% of their value at the trough. If you held $10 million in T-bills earning 2%, you earned $200,000 while everyone else lost half of everything. But more importantly, you had $10 million in a market where extraordinary businesses were selling for half price. The crash didn't hurt you. It was your shopping event. The Knight Frank Wealth Report from 2009 documented a sharp rise in liquidity preference among ultra-high net worth individuals beginning as early as 2006. These clients weren't hiding. They were positioning. Cash is ammunition. Crashes require sellers. Sellers require buyers. Buyers require cash. The ultra-wealthy accumulate the instrument that cannot be destroyed by the event they are anticipating. Then they wait. The second asset is the one that nobody in conventional finance wants you to understand. Because if you understood it, you would recognize that every major economic crisis is simultaneously a transfer mechanism. And the transfer only ever flows in one direction. The asset is distressed debt. When a company approaches bankruptcy, its publicly traded bonds collapse in price. A bond issued at 100 cents on the dollar might trade at 15 cents, 20 cents, sometimes less. The market, panicking and illiquid, prices these instruments for complete loss. Nobody wants them. Every retail investor has fled. The financial media is writing obituaries. This is precisely when the sophisticated money arrives. Howard Marks at Oak Tree Capital built one of the largest alternative asset management firms in history almost entirely on this thesis. His core argument is precise and devastating. Distressed debt is not a gamble on whether a company survives. It is a legal mechanism for taking ownership of a company's assets at a fraction of their replacement cost without paying equity price. Here is how it works. When a company enters bankruptcy, the waterfall of creditors determines priority of recovery. Senior secured debt holders sit at the top. Equity holders, ordinary shareholders, occupy the bottom rung and typically receive nothing. The bankruptcy court restructures the company. Old equity is wiped out entirely. The bondholders who purchased distressed debt at 15 cents on the dollar receive new equity shares in the reorganized entity. They did not buy stock. They bought debt. They emerged as the new owners. During the 2008 to 2009 crisis, General Growth Properties, at the time the second largest mall operator in the United States, filed for bankruptcy in April 2009. Its debt traded for pennies. Brookfield Asset Management accumulated significant positions in that distressed paper. When GGP emerged from bankruptcy in November 2010, Brookfield held a controlling equity stake in a company managing over 200 shopping malls worth billions of dollars. The total cost of entry: distressed bonds purchased at a fraction of face value. The Capgemini World Wealth Report from 2010 documented that high-net-worth individuals who maintained allocation to alternative credit strategies during the 2008 crisis outperformed standard diversified portfolios by 23% on average over the subsequent 3 years. The third asset is the oldest one. Older than stock markets, older than bonds, older than central banking. It survived every collapse on this list and every collapse that preceded recorded history. Productive agricultural land. The Knight Frank Wealth Report has tracked the Farmland Index for over a decade. Between 2000 and 2020, prime farmland in the United States appreciated by over 500%. It did not crater during the dot-com collapse. It did not buckle during the 2008 financial crisis. During the 2020 COVID shock, when REITs lost 40% and commercial real estate entered a multi-year reckoning, farmland gained 7%. The reason is not complicated. Land that produces food has a floor built into its value that no other asset class possesses. That floor is called caloric necessity. Human beings require calories to sustain biological function, regardless of whether a central bank has mispriced risk or a leveraged financial institution has become insolvent. In 2023, reporting confirmed that Bill Gates had accumulated approximately 270,000 acres of American farmland across at least 18 states, making him the largest private farmland owner in the country. Mainstream media framed this as eccentric. The financial logic is neither eccentric nor complicated. It is ancient. In the Roman agricultural economy of the 1st century BC, the patrician class systematically accumulated land during periods of debt crisis. As small farmers defaulted, massive estates expanded across the Italian peninsula. The same pattern appeared in post-Black Death Europe, where survivors with liquidity purchased abandoned farms at fractions of their former value. In post-World War I Germany, as the mark hyperinflated into worthlessness, foreign speculators and domestic industrialists holding hard currency purchased farmland from middle-class families who could no longer pay mortgages in real terms. Identical mechanism. Different centuries. Land that feeds people retains its value when the paper used to measure that value disintegrates. The fourth asset moves through the least visible channel in the entire financial system. Walk into Sotheby's New York 4 to 6 months before a major market dislocation. Not the public auction rooms, but the private treaty sales department, accessible only by appointment, operating on relationship and referral. The private data from Sotheby's and Christie's reveals a pattern that has held for the better part of 50 years. Private treaty sales spiked dramatically in the 18 to 24 months preceding major economic downturns. Before the 2008 crisis, private art sales hit record volumes in 2006 and 2007. Before the dot-com crash, the same pattern emerged in 1998 and 1999. The thesis held again in late 2019 and early 2020. This is not coincidence. It is asset class behavior reflecting a fundamental characteristic of blue-chip fine art that no financial instrument replicates: near zero correlation to equity markets. A landmark study tracked fine art returns across 200 years of auction records. The finding was stark. When the S&P 500 fell 57% in 2008 to 2009, the top segment of the art market fell approximately 4%. 4 against 57. The mechanism has nothing to do with aesthetics and everything to do with supply rigidity. A Gerhard Richter painting cannot be manufactured by a central bank. There is no art equivalent of quantitative easing. The supply of major works by historically established artists is finite in the most literal possible sense. In an environment where fiat currency supply can expand by $3 trillion in a single month, any asset with a permanently fixed supply becomes a vehicle for wealth preservation by structural necessity. Money chases scarcity when scarcity cannot be printed away. The fifth asset is the one that makes everything else on this list look like a defensive maneuver. The first four assets protect wealth. They transfer wealth at the margins. The fifth asset is not defense. It is offense. It is the mechanism through which entirely new fortunes are constructed during economic collapses. And it is hiding in the least glamorous corner of private equity deal flow, essential service monopoly businesses. After every major economic crisis in the 20th and 21st centuries, sophisticated capital systematically targets businesses operating in sectors with inelastic demand. Waste management, self-storage, funeral services, pest control, water infrastructure, medical waste processing. These businesses share a single property. People cannot stop using their services regardless of economic conditions. A family that has lost its income still generates garbage. It still requires a storage unit when it downsizes from a house it can no longer afford. It still needs pest control when the infestation doesn't consult unemployment statistics before arriving. Death operates entirely independent of central bank policy. The economic profile of these businesses under distress is almost perverse in its advantage to the acquirer. During a downturn, their revenues remain stable. Their labor costs fall as unemployment eliminates workers negotiating leverage. Their competitors, often smaller operators using leverage to finance expansion, default on debt and disappear. The acquiring entity purchases routes, contracts, client lists, and equipment at liquidation prices. Wayne Huizinga understood this before almost anyone in modern private equity. He built waste management into a national giant not during an economic boom but by acquiring small regional operators during the stagflationary recession of the mid-1970s. No innovation required. No disruption thesis. No technology edge. Garbage trucks drive the same route whether the economy is growing at 4% or contracting at 4%. PitchBook data on private market transactions documents the pattern repeating in every cycle. Between 2009 and 2012, acquisition of essential service businesses by institutional private equity accelerated by over 40% compared to pre-crisis levels.